Hey everyone, Dalton Grados with Grados Capital here. I want to make a quick video of my 5 commandments for 0-day to expiration trading. So many of you guys know I like to trade credit spreads on SPX and specifically 0-day to expiration credit spreads. And I do this for a number of reasons, mainly because I have 3 expiration days a week, so I can get 3 occurrences a week. And so have much more bites at the apple than doing monthly or weekly spreads. And also I like the fact that it's essentially day trading, so I don't have to hold anything overnight and expose myself to overnight risk. However, 0-day to expiration contracts certainly come with their own level of risk, and so I'm going to go over my 5 commandments for 0-day to expiration trading. Number 1 is wait 30 to 60 minutes after the open to enter anything. When trading 0-day to expiration contracts, they can move very quickly, and most of the volatility is going to happen within the first 30 to 60 minutes of the market open, and so I typically like to wait around 30 to 60 minutes to enter so that I can determine my directional bias for the day. Now I do understand that when it comes to selling spreads, you are giving up a bit of the IV and theta by waiting until after open, but for me, when I'm charting, it really just helps to have about an hour into open to determine sort of what the day is going to look like from there. My second commandment, and this is just me personally, is I never go over the 10 delta. So when you're dealing with contracts that expire that day, your relative deltas are going to be much closer to the strike price, and so I don't like going any closer than the 10 delta because even then the 10 delta in certain, especially lower IV environments, might only be 20 to 30 points away, and so that's just my comfort level. Rule number 3 is always take a 2x loss, and I put in here no rolling. Now I have talked about rolling in the past, and rolling has gotten me out of losing trades and have turned them into winning trades, but lately I did roll a trade that ended up going through this recent market correction, and I think I'm going to come out of it okay, but it's been kind of stressful and I just wish I took the 2x loss. So when you're selling a credit spread, of course you're putting up more collateral than there is max profit, and so in order to mitigate your maximum loss potential, you need to have a stop loss, and I typically recommend 2 times the amount of credit received. So if you're going to make a maximum of $250, then if the trade goes against you, you should be losing no more than $500, and it's gonna sting, but it'll take you 2 more trades to break even, and you know, it's much better than going to a full max loss. Okay, commandment number 4 is take profit if the spread is at 80% of max profit before 2:30 p.m. Eastern Standard Time. So in my experience, things can kind of turn whichever way they want in the last hour of trading. It's particularly the last half hour, even 15 minutes of trading. And so if I can be out before 2:30 p.m. Eastern Standard Time, that is great. And if I'm already at 80% maximum profit, you might say, well, the probabilities are just so high to just let it expire. But I'm also going to be taking on a significant amount of risk to only make that extra 20% of extrinsic value. So if I go ahead and take my profits if they're at 80% and it's before 2:30 in the afternoon, that's great for me. I can be done for the day and not have to worry about what happens in the afternoon session. Lastly, commandment number 5 is go half of the size of your typical position size or none at all on key event days. These would be days like when the Federal Open Market Committee releases their meeting minutes, any day that Jerome Powell is speaking, any just sort of significant day that's expected to move the markets. You don't have to trade. Or if you do, just go in with less position size. And that's it for my 5 commandments of 0-day to expiration trading. Look, 0-day to expiration is it's a lot of fun. You can certainly make a lot more profits by having more occurrences, but it does come with its own set of risks things can turn on you very quick because those contracts are so sensitive to price movements. So if you follow these 0 day to expiration trading commandments, you will certainly survive in trading the markets. This is Dalton Grados with Grados Capital. Thanks for watching. Don't forget to give a thumbs up, comment, subscribe to the channel, follow Grados Capital on Instagram. Let me know below if you have any other rules, any other commandments you would suggest for 0 day to expiration trading. I'll see you guys next time.